The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Welcome to episode 170 of Wealth Talk. My name's Christian Rodwell, the Membership Director for WealthBuilders, and I'm joined today by our founder, Mr. Kevin Whelan. Hello, Kevin.
Hello, Chris. I can't believe we're still going strong after 170. The highest checkout on darts, by the way, not the 180 of the 360s, but the 20, 60, 60 bull. We're going to go for the bullseye today because crumbs. There's a mess of information out there, people being overwhelmed with it. The news continues to be a nightmare, but we're going to try and bring some tax principles into play today. The all-pervasive tax. Tax is the great robber of all of our wealth, and taxes are always changing, Chris. So why don't we focus today on what is not changing? You know, the things that you can use now, even if the government continue to tinker with things, as they always will do. What are some basic principles we can use? And I suppose also a reflection of some of the things we're asking our debit challengers to do, Chris. How's that going?
It's going great. Yeah, we're in week 5. So, having so much fun in there, seeing some good savings, seeing some great shares inside the community. We're loving those live sessions that we're doing each week. And tax is, we've heard about some U-turns recently, but there's always ways to save tax, aren't there?
There are always ways. And the best way to be thinking, just as a principle, is to understand that the tax rules are there for you to maximize allowances and reliefs, and lots of different ways that you can do that, and across all the wealth building pillars, from property to pensions to investing, for having a property portfolio, being in business, creating IP and joint ventures. There are tax breaks everywhere. And the key thing is a message I remember listening to Robert Kiyosaki at one point, which is that, in the end, you have to be an entrepreneur to be wealthy. We believe that. Entrepreneurial thinking, and ideally having a business so that you can understand the tax differences between being an employee and being a business owner. But one of the key issues to recognize is, generally speaking, there are less tax breaks when you're employed. But when you're employed, you're sort of earning your money, you pay your tax and your NI, your national insurance, you spend what's left. When you're in business, you earn your money, in other words, your turnover. You're then able to spend on some of those things you can enjoy as your lifestyle. And then you pay tax on what's left. So there's a fundamental relationship shift between being an employer or being in business and being an employee working for somebody else. Do you remember I did a positioning a while ago saying you've got to know where you are in the wealth builder space. You need to know whether you're a retail customer or in the retail space paying the highest premium, getting the lowest value add, to the wholesale space where you're much more able to control your costs and increase in added value, and the creator space where you've got so many tax breaks and concessions, so many ways that you can offset things, and we'll talk about one of those a little bit later, that you can pay tax a fraction that the retail employee is paying. So just think about that positioning, Chris, and think about the different pillars as you kind of dive into my knowledge, and bear in mind, of course, for the purposes of this, as we say on all Wealth Builders podcasts and everything we do with Wealth Builders, is you need to take independent tax, financial, legal advice before you make any fundamental changes with your money. So I'm going to give you my best in this. I'm a tax savvy person, but I'm not an accountant. I'm not trained to give tax advice, and I won't be dispensing advice, just principles. Is that okay with you?
I'm sure it's absolutely fine. Now, we've been following and sharing with our Academy members news and updates from the Adam Smith Institute for a while. And there's a very interesting statistic, I guess we call it, that comes out each year, Kevin. Would you mind sharing a bit more about that? And obviously we can see if our listeners can guess what that date might be. all important
Yeah,
day?
I mean, that'd be interesting. I think you've got the actual date, but the Adam Smith Institute. Adam Smith is a famous economist, even older than me, long gone now, and his kind of institute creates something every year called Tax Freedom Day, which is essentially when you take the average taxpayer, that's across the board, from lower taxes up to higher taxes across the board in the UK. How long does it take you if you take each day in the year as, how long during the year do you end up finishing paying your taxes so you start working for yourself? And that day is getting later and later and later. What do you reckon it is this year? I wonder if people could guess. How much of the year or how much of your week do you actually spend paying taxes? Across the board. That's your income tax, your VAT, your national insurance, levies and charges, all sorts of things, council tax. What is that for the average person in the UK? And what day do you think you start working for you? Which means it's really, really hard once you hear the day to build your wealth unless you're smart, because you ain't got much of your year left.
No. Shall I reveal the date?
What's the date this year, Chris?
It's the 8th of June.
That's scary, man. That's so scary that you've got to work till the 8th of June just to pay into the HMRC coffers, and only the rest of the year you've got for your life. That's not just your utility bills that are going up, not just your your petrol bills that are going up, not just everything that's going up. You've then got to have some whatever's left after all that, and mortgage interest rates, of course, which are on the up. When you add all those things on the up, how much have you actually got left in the year before genuinely you can use that money to build wealth? And my contention is, it's not money that builds wealth. It's you. You've got to be creative. The resourcefulness of you is much more important than the resources you've got left after the end of the year or the end of the month. And some people, of course, we know, Chris, are now beginning to run out of month before the money runs out. And that's a challenge. And that's part of the reason we give so much information away for free, to try and help people focus a little so that they can make their life a bit easier. But for the majority, they've got month sorted, they've got some money left over, then it's what you do with that money, how you maximize that money, but also how you maximize yourself. And that's a key consideration. And knowing a bit more about taxes is incredibly important for all of us. Not that you need to be an accountant, not that you need to be able to understand tax law inside and out, but to be able to take advantage of the opportunities to reduce that tax bill. So instead of being part of the 40%, which is the part of the year, it's a 40% of the year, you're in a position where you can pay less taxes because you're a bit more aware, or you're tuning into people who can help you. And I'll do my best to give you some of those areas you might want to go and explore for yourself.
Yeah, should we do that? Should we start to have a look at some of the areas and highlight these? And why don't we begin with tax-free allowances, Kevin? So what are some of the allowances that people can tap into?
Well, look, everybody's got a tax-free allowance they can earn before they pay any tax at all. So you definitely want to make sure, if it's possible, that if you've got a family, everybody in the family, that means kids as well, who are entitled to a tax-free allowance. And let's just use approximate numbers because we don't want to date ourselves by exact years, but in the sort of 12 to 13,000 pound mark before you pay any taxes. So you want to be clear that are you using yours, is your spouse using theirs, or your children using theirs, because everybody has got a tax-free allowance before they pay any income tax at all. So often the skill here is being able to use ways, this is income tax, that you can deflect some of the money by having a business, engaging your spouse in the business, having your kids employed in the business. There are some rules around that, but all children have a tax-free allowance from the day they're born. So, if you've got kids who are gifted in music, gifted on stage, just gifted to be in a catalogue, whatever. If they're performing, they can earn, best part of 12, 13 grand, and all that money is completely tax-free. So think about where you can use allowances between people in the family. And once you've started to use those allowances, and most people do, of course, you've got to be very mindful of where you get to sort of some key tax thresholds. And those tax thresholds can be scary, where the amount of tax you pay is more than you think. So there's definitely one where if you've got children, where you run out, you get an income over a certain figure, 50,000, give or take, you lose child care allowance or the child allowance. You can be aware of that and offset that. Is there a way that you could reduce your income a bit if it was relevant there through something called salary sacrifice? If you're an employee, you could have a little bit more money paid into your pension so that you're earning a little bit less, you're building more, but you're keeping your child allowance. For those who are fortunate enough to earn more than 100,000, once you get between 100 and 120 grand, you're losing your personal allowance 2 for 1. What that essentially means is every penny you earn between 100 and 120, you're paying 60p in the pound in tax. If you ask most people in a room, Chris, what's the highest rate of tax? Now, I know they might get confused. Is it 40? Is it 45? We don't know. Is there a U-turn? Whatever. They'll think it's 45, but it isn't. It's 60 on that cusp between 100 and 120 when you lose your personal allowance as a result of that. So the marginal tax is 60. And then you've got the 45p personal income tax as well. So, you've got to try and find ways where you know where you are, and then if there are any techniques and strategies that you could make use of other allowances. And of course, there's dividend allowances. If your business got 2,000, you can earn before you pay any dividends. So you can pay yourself in dividends. So normally if you're in business, you can earn more before you pay any taxes by using your income tax allowance, your dividend allowances, your spouse's allowance, your kids' allowances. There's a whole raft of different things that you can do that will help you make use of all of those allowances. That give you a head start?
Yeah, really good. And where does national insurance fit into this, Kevin?
Well, the national insurance is a tax, but if you're a business owner, you can earn more money before you pay that tax. You've also got that salary sacrifice point. If you're in business and somebody comes to you and says, "Hey, I would like you to pay me less so that I can put more money into my pension," then there's no employer's national insurance. So for you as an employer, that's good news, unless, of course, you're benevolent and the employee says, "Hey, would you pay the national insurance that you were paying into my pension instead?" So you can give someone a pay rise without actually costing you any more money.
Now, obviously, in the UK, we're very lucky. We have some certain tax-free products available. I think most people are probably familiar with ISAs, but perhaps not everybody is making the best use of them. And of course, there's lots of different types of ISA, perhaps people are not aware of. So shall we look at some of the tax-free products that people could be using?
Yeah. So we've touched on, getting things that are allowances. We'll probably also touch on, Chris, things where you get tax back, so tax reliefs. But there are a number of things you can do in life, in the pillars, where whatever you do is tax-free. So the growth, which is normally a capital gain, okay, so that growth, there's a capital gains allowance. Again, it's in that sort of 12,500 mark, and that's per person. And there are many opportunities where you can use something to create a capital gain and make use of that allowance, which isn't an income. And so few people take advantage of the capital gains tax allowance, which is an annual allowance from tax year to tax year. Now, one of the things, of course, which is completely tax-free, interesting thought, is your personal residence, right? So whatever money you make on your home is tax-free, which is quite nice. But what if you chose to say, well, hey, I like the idea of doing property, but instead of doing a property for a business, I do my own property up. So I buy a property, say it's derelict or it needs a lot of work. I do the work, right? And then I sell the property, make all the gain, all those gains tax-free. We've got clients who do that, who are buying properties, and the money they make, tax-free money, is on the difference between one property and the next and the next and the next. And they're continually making money, and it's a tax-free money. Similarly, by the way, if you've got a property with good equity, now, of course, you've got to pay interest on these things, but if you've got a property that's worth a lot more money, or you've got an unencumbered property and you want to take some of the money out of the property, then you can do so essentially tax-free. So when you raise debt on your property, right? So you say you've got a property worth $500,000, no mortgage on it, say, and you want to raise 100 grand, you can raise 100 grand and all that money comes to you completely tax-free. So you can use that to spend if you want. I mean, I'm not saying you should, but you can get a tax-free income from your property. And of course, there's a massive growth in elder life mortgages, people over 55, that's elder, that's people like me, where you can tap into the equity and you don't have to pay any interest back. You can roll that interest up if you choose to, pay it if you don't want to, much more flexible, much more creative. So you can take money out for whatever purpose you want to. And that could be to improve your lifestyle because bills are going up and you want to give yourself a margin of error. So anybody over 55 could consider that. So you can see how it's even children can benefit, older people can benefit, business owners can benefit, employees can benefit. Anyway, let's not even talk about ISAs. So let's talk about ISAs. Individual savings account, tax-free, different ways to do it, £20,000 a year. And of course, you've got different styles of ISA. You've got a lifetime ISA or LISA, which is between 18 and 40. You get a bit of a tax break on that. Government gives you a little Brucey bonus for being involved in that. It's ideally for saving for your first home or retirement. So it's kind of like a pension, but without the tax relief, or a kind of help to buy that used to exist, but now doesn't exist, of course. So you've got that. You've got innovative ISA, which allows you to invest money in things like crowdfunding. So things that are not the stock market, so you're diversifying, but still getting tax-free returns. So, lots of ways that ISA, and we've definitely seen not pension, but ISA millionaires these days. Those people have used their ISA allowance ruthlessly every single year and have invested that money in different things. And there's countless numbers of ISA millionaires now. So definitely worthwhile doing. And most people know that, just like most people know premium bonds, an interesting favorite of my family, not because we think premium bonds are any better than anything else, but they're tax-free, they're a prize, you can have fun with the family, and if you've got surplus money, you've got your money allocated to your ISAs and your pension and everything else, then what's wrong with that? And certainly for younger people, giving gifts of premium bonds, and you can sit around your Alexa and on the second or third of the month and you can see who's won, and there's a little bit of fun in there as well. So it's like playing the lottery, but getting your money back if you don't win. Like, why would you play the lottery if you can buy a premium bond, 25 quid, and if you don't win, you get your money back? I mean, it's crazy, really. Just some interesting things that you can do, Chris. I mean, there's more if you want to probe further, but just give you a chance to interject and maybe have my pause for breath.
Yeah, I will. Maybe just a question, Kevin. If people are probably most familiar with cash ISAs or stocks and shares ISAs, obviously, when the rate of inflation going crazy as it is now. So, any comment on someone who's trying to build wealth in a cash ISA versus a stocks and shares ISA?
Well, I'm going to say that you don't really build wealth through ISAs. You can store up the wealth you build because it's too slow. If you've got your money in cash, you can't get a big enough return on cash. It's a hedge. If you're nothing wrong with keeping your money in cash for a period of time, nothing wrong with having money in cash for emergency funds. But you don't build wealth by having cash. You can't really build your wealth by having money in the stock market unless you've got a very, very, very long time to do it, which is why it's great for kids. And it's great if you're at the beginning, to get into low-cost funds, tracker funds, index funds, ETFs or exchange-traded funds, things where the costs are low. So just as important to pay attention to the tax is important to pay attention to the cost. And we must never, let a tax tail wag an expensive dog. You should never have a rubbish product just because it's tax-free. And we've seen lots of people do that and buy really spicy investments just because they're getting a tax break. And that gets a little bit more sophisticated, Chris, when we get into the sort of the higher, more complex instruments like EISs and VCTs and things like that, which if you want me to touch on, I can. But we'll be covering that in the debits challenge, won't we? So people want to know a little bit more about that. Getting tax relief of 30%, not a bad thing, but you will still want to make sure it's a good investment. But ISAs, good to use, but definitely not a way to build your wealth. You build your wealth by adding value. There's nothing you can do in an ISA today that says, I'm going to do something today to improve the value of my ISA. You can't. So nothing wrong with having them, but it's definitely not a wealth builder. It's a wealth diversifier, in my view.
Okay, thanks for your comments on that. Right, so remaining on the theme of tax, what about tax in the home, Kevin? There's a few different ways that people can, look at that. I'd rent a room, for example.
Yeah, well, that's $7,500 tax-free. Not saying that everybody should do that, of course not. But, if you've got one of the things you can easily do, and something I'll be doing, to moving house, and one of the things I'll be doing in moving house is rebuilding the garage and putting accommodation above it. Not because I need to rent out the space, but I could, right? And get $7,500 completely tax-free. You don't even have to declare it. So there's things you can do in your home. I've mentioned already the fact you can tap into the equity and you can create value in the property and get a tax-free income from it, but you can also rent a room. Lots of ways that your home can bring you the capacity to be able to create income, but tax-free, they're the ways to do that.
And we shared something called Form 17. What's that relate to?
Yeah, well, this is more about not the home you live in, Chris, but the home that you bought as let's say, a rental property. Now, in those people who've listened to us in the past, Chris, will know we talk about the roof. The roof is how you protect your family through wills, trusts, powers of attorney, but also, quite critically, how do you own your home? And we suggest people consider owning their home or homes they own, right, or properties, as tenants in common, not joint tenants. So joint tenants is when you own it together, 50-50, let's say, husband and wife. Very common, very typical. Pretty much all lawyers do it that way. But there's a very specific reason why, if you own property in your own name, now I'm not going to talk about when you should incorporate property. That's beyond the scope of a podcast, and other people have got expertise in that area. But if you do own property with say, husband and wife, for example, if you own it as tenants in common, so you can own and choose the percentage of the property you want to declare for the purposes of the income, you can say, hey, I want to own this property as 99% in my wife's name and 1% in my name, so that the income becomes taxable in my wife's name, not in my name. And you do that through something known as Form 17. Lots of things in tax are curious titles, curious names, curious forms, but there's a good one. Check out Form 17. And if you've got property in joint names with somebody, see if you could reduce your taxes by reallocating both the income and the capital in a different way to allow you to pay less tax, which is what this is all about.
And there's so many more. I mean, we're touching on a lot of points here, Kevin, but there's many more. Obviously, we've mentioned we share in our debits challenge, but I'll give you a second to grab a sip of water or catch your breath and head over to Trustpilot, because we've had more reviews in the last 7 days. And I'm going to pull one out from one of our very valued members, Mr. Fernando, I will refer to him as. And Mr. Fernando says, I have been with WealthBuilders now for a few months and really enjoying the content, the camaraderie and encouragement in progressing our goals. There is a real structure and process to follow, led by people with integrity who want all-round success for all. An exciting few years ahead on this journey, and I know it won't be a lonely one.
Interesting. So that's good. And from a tax thing, Can you hear the drums, Fernando? That's an interesting one. Just trying to get that. Could have a bit of a laugh. Tax is a bit dry, Chris.
Yeah.
So that's good. Good on him for making a review, and we're very pleased and proud to have him as a community member. And of course, if you love what we're doing, and I bump into a lot of people, and they say, I really enjoy following you on the podcast. And I said, well, why haven't you left me a review? So if you're liking the podcast, just let other people know you're liking it, because then people who follow you will follow us. And that means we're getting more people on track to becoming financially independent. And we're happy to do that. 170 episodes in, Chris. We are committed to the cause.
Absolutely. And look, we know we get 10,000 plus downloads a month, which we're so grateful for, across over 100 different countries that are being downloaded in. And I tell you what, Kevin, we're on 191 Trustpilot reviews. Do you think there's 9 people listening who in the next couple of weeks might find a minute or two to go and leave us a review and say how much they've been enjoying the podcast?
Do you know what? There's a brilliant book, and we'll be probably just re-interviewing this guy called Dan Hill, called Karma Credits, right? It's just a great thing. And it's about doing good things, not for self-gain, but because you are selfless. Do a selfless favor to me. If you're listen to the podcast, you've got any value at all, or you just believe I'm trying to give you value, could you be one of the 9 people who will get us to 200 by the end of October? Come on, do me a favor. Just jump on, do a Trustpilot review, and let us get up to 200. Then we'll keep ahead of ourselves on our podcast, right? So we want to get to 200 before we get to 200 episodes. So we should be able to do that by the end of the month, Chris.
Yeah, and it's dead easy. You can just go to wealthbuilders.co.uk/reviews. You'll see a Trustpilot logo. Just click that. That'll take you straight to the page where you can just put a review. And we'd absolutely love that. And of course, we will give you a shout out in the coming weeks as well. So, okay, we talked about children earlier, Kevin, but tax for kids, there's obviously a junior ISA as well. We didn't mention that one, I don't think. And junior pension.
Yeah, there's things for kids that you can do anyway. But the principle, I would say, is don't do products for kids. Don't just do things for them. Do things with them. Yeah, kids are sponges. We know that. They follow you, even if you're not watching. So the more that you can bring money as a discussion point into the household, to be open and transparent, and to want to involve them, not necessarily in fine detail, not necessarily in where you are financially, in actuality, but share things that you can do with them. So, for example, the fun thing there with the premium bonds is getting them involved, getting them excited in a way. You could open accounts for them. There's so many different accounts these days. We won't signpost any particular names, but where you control the account, but the children are getting used to allocating money in different things, whether it's saving, spending, giving. You can create little accounts for them so they get used to purposes of money. And then with the giving, you can encourage them to be gifting or giving that money to other people so they become sharers. And then that's kind of karma again coming back to them. So all very interesting things. But if you want to build money for them, other than the premium bonds, ISAs can be used for kids. You can take them out. They get them when they're 18. They take control. So you definitely want to build their knowledge and wisdom over time. You can also take out a pension. Kids can get tax relief, right? So even though they don't pay tax, most kids don't pay tax, but kids can get tax relief if you open a pension scheme for them. Because remember, I said to you, the stock market won't work to build your wealth unless you've got loads of time. How long do you need? 30 years plus, probably. Certainly 25 years plus. If you've got somebody who's 2 and you're a granddad or a grandma, you could put a bit of money into a pension scheme for a youngster. By the time they're in their 50s, they'll be pension millionaires. They'll be set. So you can do that. And you can pay 3,600 gross, 3,600. That's 2,880, I think, net. So anything between 0 and 2,800 you can put in, and the government gives money on top. So instead of being a taxpayer, your kids are being net receiver of a tax payment way before they're ever paying taxes personally. So that's a smart move.
Yeah.
So lots of things like that you can do with and for your children, but I emphasize the with.
Sounds like there might be some children and grandchildren in the background there as well, Kelly.
That was my grandson in the background. That's Finley, and so we'll talk about Finley on another day.
Yeah. Well, look, we've covered a lot already. I think we should round things off shortly. But you did mention EIS, so anyone who was listening who wants to understand about that, maybe we should touch on that just briefly.
Yeah. So EIS, Enterprise Investment Schemes, is designed or introduced to the government really to try and help really encourage small businesses to grow by getting access to capital. So the Enterprise Investment Scheme gives you a 30% tax break on your income, right? So it's not a bad thing. If you choose a good investment, you've got to hold it for a certain period of time, 3 years. Once you've held it for that period of time, then any gains you make are entirely free of tax. He's been encouraged to scream a bit now, isn't he? But there you go. Yeah. Normally, Chris, in my house, I get interrupted by a howling dog or a howling wife. I've never had a howling grandson. Somebody's teaching him how to scream just at the time when we're doing a podcast. But
he wants 15 minutes of fame.
He wants paying. I said earlier on, if your kids can perform, they can earn money tax free. He's basically saying, Granddad, I'm performing now. Will you pay me some money and I'll get that tax free? By the way, the money's got to go to kids. If you keep the money, you can only make £100 before the tax is actually applied to your own personal tax. So you've got to be very careful. You can't pretend to put things in kids' names. You've got to do it. Okay. Oh, EIS, right. So Enterprise Investment Schemes, VCTs, similar thing. Venture capital trusts, it's a tax break. Complex areas, you need to be probably high net worth or sophisticated to really get into the details of that, I would suggest. And anybody who wants to do that, get in touch with us, and we can help you understand those things through our partners. We don't obviously give advice to anybody on anything that's bespoke and unique to you, but for some people, they can be right on the money. And of course, the biggest tax relief and tax benefit of all, Chris, is the pension, and we hear a lot on WealthBuilders, the SSAS pension, or the small self-administered scheme, which allows you to put more money in than any other pension. I won't go into the details of that, but most pensions you can only put in a certain amount. With the SSAS, you can put in up to $500,000 in 1 year and get all the tax back in the same year if you're a business. So successful business owners, that's an interesting one. Of course, that's not going to apply to everybody, but the real benefit of the SSAS pension, and all other pensions too, in reality, is there's no income tax, corporation tax, capital gains tax, or inheritance tax on pensions. The benefit of SSAS, of course, is not just the additional relief, but the wider range of investments you can make if it's right for you and you're a business owner. If not, other pensions can work just as well. Can't have a child in a SSAS. They've got to be 18 because you have to be a trustee, and you can't be a trustee till you're 18. But these are all kind of a whistle-stop tour around some various things around tax. But the point is, whether they apply to you or not, or you know them or not, find somebody you can trust who can help you understand where the tax breaks can come in your direction, and either introduce you, as we would, to experts if what you need is complexity. If what you can deal with is the simplicity of basic principles, then we can help you understand those things.
Yeah. Well, I'd like to hope there's at least one thing for everyone listening shared today that they can take action on. And if we can help you, reach out to us. Easy to get in touch. Send an email to hello@wealthbuilders.co.uk, or book a discovery call, and we'll have a short chat on the phone. wealthbuilders.co.uk/discovery call, and lots of free information alongside the podcast inside our free membership area. So if you're not already a member, do head to wealthbuilders.co.uk/membership.
Yeah, and just a quick signpost on a few things, Chris, that are very common questions I'm getting these days. What's the difference between a SSAS and a family investment company, for example? Should I have a family investment company? What does that mean? How does that work? These are good questions. I've got a portfolio of property. I mentioned that earlier on, whether you have them in your names and your joint names or as tenants in common. should I incorporate? Should I put that into a company now? Again, these are areas that the partners that we work have got expertise in that area. And we can invite them into webinars so that you get access to that general information completely free of charge, as part of being in our membership. And those who offer consultation calls will, more often than not, for Wealth Builder clients, those initial consultations where you can get most of the answers are completely free of charge. So there you go. Little shout out, because tax is the biggest drain on all of us for our wealth building. So being tax savvy is a critical skill to have if you're a serious wealth builder and you want to be financially independent, because that tax is going to apply forever. So being tax smart, really important.
Yeah, really good. Okay, go now. Leave us a review. Let's see if we can hit those 9. And we will be back here, same time, same place next week, Kevin.
We will, Chris. And until then, my friend, see ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the Wealth Builders membership site to help you create, build, and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.